All right, welcome to Talk Tickers. Today we're diving into Matador Resources' latest third-quarter earnings. Now, on the surface, this quarter looked absolutely phenomenal. But, the market's reaction? Well, that tells a completely different and, frankly, a much more fascinating story.
And that really gets us to the heart of the mystery here. I mean, think about it. Matador comes out, they beat on earnings, they beat on revenue, they hiked their dividend by a whopping 20%, and they hit a brand new all-time production record. And for all that great news, the stock just gets clobbered. It drops almost 10% on some really heavy trading volume. So what in the world happened here?
So let's just lay this paradox out, side by side. In one corner, you have all the headline wins. Adjusted earnings per share of $1.36, that's a nice 14-cent beat. Revenue of $939 million, a solid 6% beat. And of course, that record production. By any normal measure, that is a fantastic report card. But in the other corner, you have the market's verdict, which was, let's be honest, swift and pretty brutal. A 10% haircut. That's the disconnect we really need to get to the bottom of.
Okay, so to solve this puzzle, let's start by looking at the story that Matador's management wanted everyone to hear. This is the bull case, and it's built on a quarter of just pure, unadulterated operational excellence.
It really all starts right here. A new record, almost 210,000 barrels of oil equivalent per day. You got to understand, that's a massive 22% jump from just last year. This isn't just a number on a page. It's proof that they are running an incredibly efficient machine out there in the Delaware Basin.
And you know what? Management didn't just talk the talk. They put their money where their mouth is. A 20% hike to the dividend, that is a huge signal of confidence. It tells you they believe in their future cash flows, and it's a direct promise to return more of that cash to shareholders. It's exactly what you want to see.
And their efficiency story gets even better. Now, hang on, we know total spending is going up. We're going to get to that, don't worry. But look at this. Their cost per foot of drilling is actually dropping. They're guiding to a new, lower range, and they're doing this with cool innovations like something they call trimul-frac, which is basically a way to complete multiple wells at the same time. It makes every single dollar they spend about 20% more productive. Super impressive.
And this quote right here just shows you how convicted management is. The CEO, Joe Finnon, he was basically defiant on the earnings call. He was telling the market, look, we do it all over again. The spending is a strategic investment, not some mistake. They see projects with huge returns and they're doubling down, convinced it's the right play for the long haul.
And hey, the bull case has a rock-solid foundation too. I mean, this quarter, they bought back $55 million of their own stock. They paid down over $100 million in debt, which makes the balance sheet even stronger. Their San Mateo midstream business, it's just a cash cow, turning out another $74 million. And here's the kicker. They're already telling us that by 2026, they expect to spend less money and get more production. So, I mean, from every angle, the fundamentals look great, which brings us back to that question. With all this good news, why the massive sell-off?
Okay, let's flip the script. Now we have to look at the bear case. This is the story the market actually heard. And honestly, it all comes down to one single number.
And here it is. This is the smoking gun. This is the number one reason the stock took a nosedive. Management absolutely jacked up its capital spending guidance for 2025. The street was looking for capital discipline. What they got instead was a spending increase of roughly $200 million. That was it. That was the trigger that sent investors running for the exits.
And that spending hike, it just lit up a whole bunch of investor fears. First off, higher spending means less free cash flow. Less cash for things investors love, like buybacks and special dividends. Second, with oil and gas prices getting a little soft, it looks like they're spending big right into a down cycle. And the market has a long memory. It's been burned by energy companies that chase growth at the wrong time. So the fear is that Matador is prioritizing barrels over actual returns.
And you really have to remember the context here. This is so important. The stock was already down around 23% for the year before this report even came out. The market was already feeling pretty defensive, pretty nervous about the whole energy sector. So it was on a hair trigger. And that meant any news that was even perceived as negative, like a huge spending increase, was just going to get amplified big time.
So what do we have? We've got a company that is absolutely firing on all cylinders operationally, but it's going up against a market that is just terrified of overspending. So how do we square that circle? Well, let's get to our take on all this.
Okay, so we're going to break this down with our usual framework. First, we'll give you our prediction for next quarter. Then, we'll talk about the key things you need to be watching for. And finally, we'll give you our official equity research style rating.
So, our final verdict on Matador Resources is a market perform. Here's the thinking, plain and simple. This company's operational team is best in class. They are absolutely crushing it, but right now, all that great work is being totally overshadowed by the market's fear, and it's a valid fear, about capital discipline, especially when commodity prices are all over the place. The big risks, if oil prices fall further, or if they don't deliver on that promise to cut spending in 2026. Until they can prove to Wall Street that they have that discipline, we think the stock is probably just going to trade in line with the rest of the market.
All right, but before we go, let's have a little fun and talk about a bit of an outrageous but still plausible trade idea. Think of this as a hedge fund style what if.
So here's the idea. It's a bet that they finally unlock the hidden value in their San Mateo midstream business. Even management admitted on the call that they don't think the market is giving them any credit for it. So the play would be for them to either spin it off as a separate company or just sell it outright. Now this would do two amazing things. One, it would bring in a ton of cash. But more importantly, two, it would force the market to look at their core oil and gas business all by itself and value it based on its incredible performance. That could trigger a major re-rating of the stock. It's a real potential game changer.
And as always, please remember, this is not financial advice.